Peter, you're very welcome to the ScaleX Insider podcast. Delighted and thrilled to have you on the show today.
Thank you very much. Thank you very much, Brendan. Thank you for inviting me.
You're very, very welcome. Really looking forward to the conversation. You know, given our conversations previously, that our vision is to inspire, connect, and enable millions of ambitious leaders of small and medium-sized enterprises to scale with purpose. So I open up the show with this question to all of our guests. Peter, what does scaling with purpose mean to you?
Yeah, I had to think about that. I mean, there's a difference between scaling with purpose and scaling with a purpose. So I'm assuming that you're missing out the A. So scaling clearly is not just organic growth. Well, it could be organic growth, it could be organic scaling, but it's faster than linear. So it's something that's scaling faster, exponential to some base of some sort. So it's rapid growth, painful and sometimes expensive. So that's the scaling bit of it, which we're all hoping to do. There are many people who start companies and never get to that phase, and they all wish they could do. The investors definitely wish they would do, and many don't. And then the purpose, there are two ways of looking at that. You could look at it as a social purpose of some sort, which might just include employing people, but generally have some sort of ESG-based social outcome. Or you could do it as the word purpose without the A, which is with using the right culture, making sure the senior leadership team work together properly. Generally that's the company, of course, it has to be sustainable as well. So it really depends whether you put the A in there or not. So is that the sort of answer you wanted, or is that too complicated?
Not at all. We could drill into that. That aligns with my own belief on scaling with purpose, and really, it's for our listeners, it's about amplifying your impact. It's about bringing your wonderful product or service to the world, and focusing in terms of being purposeful, focusing on either, your competence, which is your product or service, your culture, which is creating a wonderful organization that through the scaling helps scale up the potential of your people, or a cause, as we see with Patagonia, for example. And you're right in terms of the challenges, because just for context, less than 1% of SMEs currently in the UK are achieving scale, and access to finance is one of the greatest impediments as to why companies don't scale. I'm keen for you to share kind of an abridged version of your journey to arrive at a point where you're invested in 76 startups, and you become the business angel investor of the year. So how do you arrive at that point, Peter?
Totally by mistake. Just by grasping opportunities, by being open to take risk, to see an opportunity, grasp it, and then run with it. And fail, of course, as well. So I'm 67. My first startup, I was 19. Well, it wasn't a startup; it was a small business. I've been doing it for nearly 50 years now. And one of the most important things, which was just luck, complete luck. I worked for probably the most famous Australian entrepreneur and explorer when I was just 18 years old in Sydney. It was almost unknown. It was completely unknown then. He had just had one shop, this guy called Dick Smith, and he has become super famous. So it's some of his enthusiasm and madness almost rubbed off on me. Anyway, so I've set up about a dozen businesses, all small. None of them have grown beyond about 30 people, but I've had the ups and downs of that. Some have been in tech, some have been in property development, some have been service businesses, some have been product businesses, some have been B2B, some have been B2C. So I've sort of built up, sort of by mistake, in some ways, but just by grasping opportunities, huge amounts of knowledge. And then about 15 years ago, after I went to Cambridge University and did engineering. I moved back to Cambridge, which is a hotbed of technology and startups and capital as well, availability of capital. And I decided I'd stumbled into being an angel investor. I was mentoring somebody, and I invested in the company as he set it up. It wasn't really angel investing. It was really a financial co-founder, which is slightly different. And we exited that after about 3 years for a 17x, I think it was. So it was a pretty good return for all three of us. And then I joined a group here in Cambridge called the Cambridge Angels, which had been set up a few years beforehand, which then gave me access to deal flow. It gave me access to skills. it gave me access to connections, and that group sort of started told me. I got almost all my information initially from them as angels, and then of course the roles reversed, and I became chair of the group, and I started, as you can see behind me, started writing books. I got very involved in the ecosystem, so on the board here in the UK, and then I became the president of the European Business Angel Network. In fact, I was in Dublin only a few weeks ago talking to angels, the angel group there, the H-band group there. I'm also on the board of the Global Business Angel Network. So I've sort of, I've grasped opportunities, but I've also done it because I've been very lucky. I've really, really enjoyed everything, or almost the whole of my working life. Obviously, lots of stress as an entrepreneur, much less stress as an angel, particularly if you've got a wide portfolio. If you've only got 3, then I can imagine you get quite emotionally involved. But we've only got 70 odd. You try to help them, of course, but you just accept, a good proportion of those will fail.
What a background. As I mentioned at the outset, access to finance is one of the greatest impediments as to why SMEs are challenged to scale. That sits alongside access to talent and access to new markets. I believe sales is the lifeblood of a business, but cash is the oxygen. So it's the sales that carries the oxygenated blood to every vital organ of the business. We are challenged, certainly within a scaling business, to access that oxygen. What do you look for in a business prior to making the decision to invest? Let's get super practical here and super granular.
I'm actually going to preface that with something which is going to say, before you feel you need to or even approach getting external investment, and by this I mean equity investment rather than debt. Debt is really difficult to get hold of unless you've got something as security in the background. But before equity, look at customer income. The thing about customer income is that you are receiving cash, which will pay the bills, and you've got product market fit by definition, because no customer is going to place an order, accept delivery, and then pay you unless you've got a fit between the product or service you've got and the market themselves. Because you've got to do a price that's right, so you can make a profit on it. Anybody, anywhere can sell something at a loss. There's no doubt about that. And people do loss leaders, we might come to later on. So if you can get it from customers, do. Now, of course, if it's a technology business where the technology needs designing and then the market needs entering, that can't possibly be possible. I use an example of a drug. So if you're going to bring a drug to market, you can't have product market fit to start with, because A, you haven't got the drug, and B, you certainly haven't got it to market with all the regulatory hurdles. So therefore, if you can't do product market fit, which if you're a small service business, if you're a graphic designer, a web designer, a hairdresser, there's lots of small businesses which can get product market fit the moment they open the door. They might need some capital to set up the hair salon or the office or technology equipment, etc. But so small businesses don't necessarily need equity, and we know that because by far the vast majority of businesses in the UK, there are 5 million businesses, and there's probably only about 200,000 that have external equity. There are many, many, many businesses that don't have external equity. Anyway, so that's just as the preface. Equity isn't the be all and end all. So look at customer income first, because there's no dilution. And there's nobody like me hanging around on the board or as a shareholder, which might, we'll come up to that later, the disadvantages of having equity investment. Anyway, so what do I invest in? It took me about 2 or 3 years from when I started that I realized I shouldn't invest in a product or a market or a service, or I shouldn't think I was the customer. I just invest in the people. And I'm sure you've heard this on however many interviews you've done. It always comes down to the people. And I will use the plural there, not the singular. It's really difficult for investors to invest in a single founder. Now, it does happen, of course, and there are some great examples. Well, WeWork might not be a good example, but it got quite a long way before it stumbled and has now failed. It's 2 or 3 founders, not 4, 5, or 6, which you do sometimes see, but 2 or 3 founders, let's take 2, will act together as a combination of being much more the sum of the 2 parts. So primarily this is because, of course, you're doubling the skill set there. If they're both software programmers, you're not, but the chances are one of them's got quite a good commercial outlook and one's fairly deeply technical, assuming it's a technology company. And angels mostly invest in technology companies because they scale without increasing the number of staff. So that's a really important part.
Yeah, I want to kind of recap on that for the benefit of our listeners. What we're saying here is that, and we drill into a little bit more as to why more than one founder. But what we're saying, and I can relate to this, our own business, Simple Scaling now, myself and my business partner Claire, we couldn't be more different. But we're absolutely aligned in the context of the vision that we set, and we tend to play kind of. I would say I'm the visionary. I've crafted the vision for the future, and Claire's wonderful at operationalizing that vision. Our skill sets complement one another, and the things that I love doing, she doesn't specifically like doing, and vice versa. So it works really well. So tell me a little bit more about that. That kind of 2 or 3 founders.
Yeah. Okay, so yeah, we've got you're spreading the skills. So, but of course, that's still 2 separate human beings. But it's the way they work together, and the way that you and Claire, I'm sure, work together to solve problems which a single person won't be able to solve by themselves, by discussion, by maybe external connections, whatever. That you two together, I'm sure, can work through a problem and get a better answer, a more sustainable, fairer, probably answer than you could if you're by yourself.
Yeah, completely agree.
So it's absolutely normal for I've actually invested in more than one. Probably out of the 76, there's probably been 3 single founders out of that lot. In one case, one I got a good exit from, for instance. Just point out that on my website, petercowley.org, there's all my investment criteria, all my positive exits, negative exits, and all my portfolio. And one of those is an example where there was basically a single founder that had 90% of the shares and the co-founder that only had 10%. Personally, I think founders should have equal shares. Possibly, maybe you and Claire both started off with 50%.
Yeah, it's exactly that, 50-50.
It works much better that way than have somebody who's not necessarily dominant in terms of character, but dominant in terms of shareholding. They're on different journeys. If you get a 10 million exit, one person's going to get 10 times more than the other, if money mattered, of course. Yeah. So it's them working together that makes so much difference, having 2 or 3. But once you get more than 3, the problem is, and I've seen many examples of this, 1 or more founders in time will drop out because they've lost the vision. They fall out emotionally, potentially, or they get on and do something else. And so when you've got something where you've got a pie divided by 4, and at the start, and everybody wants a big exit, say if there is a financial drive, you're going to end up with a bigger pie than if you just got 2 in there. As you can imagine, the valuation will be higher. And of course, if the founder drops out, and of the 170 so founders I've backed with money, about 35 have dropped out somewhere on the journey, either because they've been asked to leave or because they've left because they wanted to do something else. And that is a really tough thing to do, emotionally tough. And there's also what to do with their shares. So that's why 4 or 5 or 6. But again, there are always examples where it has worked. So
yeah, I know, and I appreciate there'll always be outliers, but your rationale, it makes complete sense. And certainly my experience, both in the existing business and the previous business, where there was a founding shareholder, and then myself and another gentleman who were also shareholders, and we scaled that business from 3 million, 15 people to more than 100 million revenue and 700 people across 6 continents. And we all had different skill sets and brought that to the table. So look, that resonates strongly. What I'm keen to understand, especially for our listeners, you're 68 now. What do you look for in people? So beyond the number, when you say people, tell me more about the characteristics of those people that you invest in. And maybe what I'm keen to understand, has that changed in kind of the last decade, given kind of the number of years that you've been on this planet and what you've come to realize, what you maybe what you valued 15 years ago is different from what you value now, and
Yeah.
ultimately has
Okay.
it?
So they've got to be passionate about what they're doing. We talk about the 3 Ps or the 4 Ps or the 5 Ps. It's got to be passionate, because it's a tough journey. I often say to entrepreneurs, the easy bit is raising finance. The difficult bit is actually building the business with that finance. You're on sale. All you do is basically, when they're raising finance, is to sell themselves to us. We buy shares and give them money. So that bit, relatively, compared with growing teams and all the HR issues, etc., with that. So they must be passionate. They must be knowledgeable. Clearly, they must know the sector they're going into or the technology they've got there. But those are actually not as important as 2 other things. One is they must be, and this American word, coachable, although we seem to be adopting it over here in Europe. So they must be coachable. And I don't mean coachable, they must listen. And it isn't just listening to me, obviously that's quite important at some point, but they must be listening to the market, they must listen to their staff, they must be, possibly accepting advice from a professional coach, perhaps. So there must be somebody who's super focused, wanting to disrupt what everybody's saying, no, it won't work, it won't work, it won't work, but at the same time listening, because they'll inevitably, if they're going to scale a business, pivot at some point. This means changing direction. This means listening to the current market in whatever way, whether that's customers or whatever data gets at, and then also predicting where they should be going. The exit I was talking about a moment ago pivoted dramatically from being a deep tech company to being a workflow company, and sold itself as a workflow company. I must admit, I was on the board with one other person. We weren't very keen on that pivot. As it turned out, it was the best thing to do. So he actually had looked around and...
So how do you determine if someone is coachable? So, okay, what's very clear is if you ask the question, have you got a professional coach? They said, yeah, I believe in coaching. I've had a coach, I'm now on my third, and I wouldn't scale a business without a coach. If they haven't, and they've never been formally coached, how do you discern that they're actually coachable?
Well, that's it's a bit like, how do you know who to back? This is a lot of gut. So there isn't actually a process for doing this. What you're doing when you've got to the point where you'll speak to an entrepreneur after the first pitch, which is just to get to the next conversation for both parties, you've got to work it out by just asking them things and seeing how they react over a period of time, not just over 20 minutes or something like that, probably over a period of a couple of months. So my average is about 5 months from point of contact to investment, and a couple of months of that usually is negotiating the term sheets and the legals and everything else. So it's about 3 months on average. It will never be less than about a month, and hopefully it's never more than about 6 months. And during that time, you're talking to each other, you're helping them. If it's very early stage or they're young entrepreneurs, you're probably helping them build the plan so it becomes more investment ready, etc. So you spend time working out their characters and working out that they've got the right characteristics in terms of, as I say, drive and direction and belief in where they're going, because they're almost certainly doing something that other people are not doing. You hope. You don't really want to, but you won't. I'd never invest in a business that its unique selling point was price, for instance. It would have to be something more important than that. So, which is why I hardly ever do consumer, actually, business to consumer. So you're working this out over this period where you're just spending time with them, but it's not just spending time in if you can do this in a environment, in a business environment. It's also going out for a pizza or something, or certainly very often in COVID, going out for a walk, or spending time to understand the character. That's more important if you're leading the round and will be on the board. But for others, angel groups usually work on the basis of a deal lead by the angel. Sometimes you'll get the entrepreneur leading, but it's most likely the angel, and they'll be the person spending the most time trying to work out whether these people are coachable, the entrepreneurs are coachable, and then passing back to the rest of the group.
And Peter, sorry, just on that, drilling into that a little bit more, because I know we'll have people who are listening who are in this process at the moment, are certainly contemplating approaching angel investors or private equity. They will certainly admit, they'll certainly say that they're passionate. They'll certainly say we've more knowledge than anyone else about this industry. How will they know whether they're coachable or not? What are you looking for? And I know you say it's gut, but have you had instances where you've had a passionate candidate in front of you, they're really knowledgeable, but actually you have concluded that they're not coachable? What are the warning signs?
Often. It's the way they react to questions, the way that they, simply. I mean, it's when you're getting to know any other human being, you're working out whether you can relate to them in some way. Which of course has its disadvantage, because if you're an ethnic minority entrepreneur, you're less likely to relate to an older white man, for instance. So, that is some unconscious bias floating around there, which has been very disadvantageous for because until about 5-6 years ago, most of the wealth, certainly in the UK, was at the early stage level, and even the VCs was controlled by white men. So that is a problem there. It's the way that they react to questions. I mean, there are situations I hear where an investor will try to trip somebody up, but that's just not my character to do that. To ask a question which then proves that they are either lying or not capable of understanding, not having enough emotional awareness. I mean, but you're quite right. How does an entrepreneur know that they're coachable before they don't? And they obviously don't know they're not coachable, in which case they've just got to try it and see what happens. Can I just add one more? Sorry, just to interrupt. One more point. The other thing apart from coachable is back to what I've just said, lying. They must be honest with themselves. They must be honest about their knowledge, what they don't know. If they're honest about that, then you'll know that they're coachable. They've got to be honest about their past. And I've got on my website, it says that I'd rather invest in an entrepreneur who's tried before and failed, because they'll have learned so much from that journey, providing they're open and honest about why it failed. Because most companies fail because of failure by the entrepreneurial team, the senior management. It's rare that you can ever blame it on anybody else. If you, for instance, had a big bad debt, it's the team, it's the company's fault for giving too much credit to a single entity. You might want to blame it on that company, your customer of yours that went bust, but it's not that. It's the fact that you made the decision to put too much risk by advancing too much credit there. And this applies specifically for entrepreneurs in their past. They're going to enhance what they've done. We all know that, because it's a selling process. They're selling to us, aren't they? But I mean, an example I use there is an entrepreneur who came to us some years ago, and he's still surviving. He's managed to raise some money, but he came up with a statement that I had a good exit. And then I found out that exit was insolvent. There's no way you can class a good exit, an insolvent exit, as being good. So it was a lie that was so easy to work out, because in the UK, our company's house is much more public than it is in many other countries. So you can just go back and see the filings to see the insolvency. So yeah, being honest, because you want them to be honest on the journey. Once you've invested, you want them to tell you that things are going wrong. You don't want it to be hidden. You want to be, particularly on at board level, you want to be able to help them with, putting more money in, perhaps. Things are, they've suddenly found that some tech doesn't work. Don't hide it away until the last minute. Otherwise, you just come to the board, the tech's not working. We're never going to give you any more money there. You've just got to be honest on the route on the whole time. And so this honesty applies both in the past and in the future.
So passion, being knowledgeable in your particular sector, coachable, having that absolute belief in the vision that you've set, being honest. And what I'm hearing there is being really transparent with your past, disclosing everything, because ultimately, as we know, all of these things through the due diligence process get discovered anyway. So it's much better to be honest and transparent right from the outset. Anything else?
Well, there's expectations. I mean, that's very mine. That's part of due diligence. I'm just thinking about their own living costs and living environment, the backgrounds. It's actually quite difficult to invest in a entrepreneur that has, for instance, expensive school fees, if they're private school fees. It's also on, and this is wrong, and this has changed, thank goodness. It was sort of expected that entrepreneurs would put in 70, 80, 90-hour weeks. And so therefore, an entrepreneur that had children or even had a mortgage or something weren't looked on nearly as much, because we knew they would put less time into it. But gradually, to come back to your question before, over the last 10 years, 15 years, this work-life balance has become more acceptable. The entrepreneur, although they will spend a lot of time, almost certainly more than the 40 hours a week or whatever, you don't expect them to actually become mentally ill or affect their own relationships by doing that. And just actually to illustrate that, the average age of the entrepreneurs I invested in is 37. 37, that's the average. That means obviously there are quite a lot of 20-year-olds, but there are also quite a lot of 40-year-olds as well. Yeah. And 40-year-olds, as I don't know, I haven't looked at your LinkedIn but recently, but I suspect you're heading that way if you've not got that. So you know what your life is. You might have kids and family and commitments and etc. So you can't expect the entrepreneur just to be 100% committed to the startup. They probably will be because of their passion, but they shouldn't be. You can't expect that.
Yeah, what I'm hearing, and I'm smiling here because you're very generous with your praise there. I am 48. My eldest daughter is 20. So, but absolutely delighted with that discreet compliment there, Peter. So I'll take that. So, what I'm hearing then is demonstrable commitment, but not to the point where there's an acceptance that actually those on the entrepreneurial journey, and I believe that the most successful entrepreneurs only start their entrepreneurial career at 42 is the average age. So there's an understanding and acceptance that actually work-life balance is important, but you want to be able to demonstrate that commitment. And I suppose wrapped in all of that is an understanding that the person that you're investing in is already living within their means. So they're not living a high life that there's a fear and anxiety that actually your investment is going to actually fund the life that they're already living.
During the journey, we expect them to increase their capital because we're wanting to do. That's what we're motivated.
Of course, that should be their aspiration, but not before time. Let's say so. Exactly. So look, that's wonderful. What I'm curious to understand, Peter, and especially giving the essence and purpose of this podcast, and we distinguish between the startup phase, the scale-up phase, and the selling phase. You've had experience across all three phases, more laterally, certainly in the startup phase, but ultimately you want your investees to scale up. What do you see as the challenges for leaders who have successfully started transitioning to that scale-up phase?
Obviously, capital. There's a lot of capital. When you're scaling, it's unlikely you're doing it through profitable sales. You're investing in sales teams. You're probably still investing in technology or the product itself. It's unlikely that the gross margin is high enough to actually fund that exponential growth without external capital. So we need to have founders that are, obviously the fact we've already invested means they're good at selling equity. And the process is sell equity, sell the vision to early employees, sell the product. But that's the selling part of it. That's the commercial person if there are two differences between the founders. So capital availability, and it's surprising that people can raise capital for, as you must know, several rounds, and then they can't any longer, despite their charisma, their stage presence or whatever it is. They just can't convince. And most failures, as it says on my website, are of the business of the 20 or so business I've invested in that failed, because product market fit hasn't been reached before investment dries up. So let's just explore that. So if you reach product market fit, you've got enough profit coming in to fund the business and to fund some growth of some sort. But if you haven't got to that, you're relying on investors to keep the business going. And if you lose faith with those investors and the investors you have at the moment stop investing, then you're very unlikely to find money from other investors, because they're going to say, well, why aren't your existing investors putting any money in? And so at that point, then you've got three choices. Either you go bust, which is usually the case, or you sell for a very small amount of money, because fire sales are difficult, or you'll end up reducing your size in order to break even. So capital availability, and by far, in fact, this is probably even more important, is human capital availability. The people that you've employed at an earlier stage won't necessarily be able to grow with the business. So you might need to replace them. And that is really painful. You've got somebody who started, probably employee number 4 or 5 or 3 or something, and they can't scale beyond 30 people or something. They can't, or their aspirations are more than their ability, which means either moving them sideways or downwards, or them leaving. So the founders have got to get used to the fact they're going to have to let go of people that they've built up a good relationship with. They've actually built the business well, and the chances are they've probably got some options there. So they've got something. They've got some capital contribution if there is ever an exit. But this applies obviously also to the founders. And I've always told my founders for the last 12 years, if you don't grow faster than the company's growing, you won't necessarily be there at exit.
Tell me more about that, Peter, in terms of the personal scaling journey that the founder must go on in order to continue to have capacity in their vision to allow the business to grow. Exactly.
Yeah, it's something that some people have. The person I talked about before, the company's Arachnus. It's on my website anyway. People can look at that. The guy did. He knew that, and in fact, he was much more capable than just starting out. He was capable of running the business already. He was impatient to grow the business, and he was certainly capable. He'd sold at about, well, I won't mention the number, but it was under $100 million, but it was still a decent sale. And he grew, and he was the top of that the whole way through. But if they're not, and you can't detect this necessarily right at the beginning, that how fast they'll grow, or whether they'll grow fast enough, because you're talking about a multi-year time frame. And if you back a younger founder, they obviously mature very much more per year than an older founder does, but years still pass at the same rate. So you've got to make them understand that if they need external coaching, this is where, as opposed to mentoring, this is where coaching really fits in, that they buy that in at probably quite a high price at the right time. So they're being led through the process of personal development. And otherwise, and this happens to so many businesses, the business will stagnate because they're not good enough to lead on to the next part of the journey.
Yeah, I want to drill into this a little bit further. The very first principle of our 10 principle ScaleX framework is psyche. And we assert that actually the business will never scale beyond the framework of the leader's own psyche. So yeah. The organization is really the team scaling, and the organization scaling is really an expression of how the actual leader has scaled themselves. Yeah. How, for those listening and maybe kind of hearing this for the first time, if they're regular listeners to the show, they won't have heard it for the first time, but what are the warning signs? Because in that early days, there's a certain level of kind of invincibility in that startup phase where you're kind of encountering a challenge, you rally the team around you, you overcome that challenge, you move on to the next challenge, you're pitching for investment, you get the investment, you get, and I have found a level of hubris at times within those startup entrepreneurs, which doesn't necessarily serve them in the scale up phase. So what should the leaders be aware of? What are some of the warning signs that they should be looking out for to conclude that actually, oh, there's things that I need to develop at a personal note here?
Yeah, well, assuming you've got the emotional awareness to actually do that, and not, unfortunately, many people don't, and particularly the ones who are probably very good at the stage of pitching may have less emotional awareness. Strong emotional awareness doesn't always go with a strong ability to pitch and to, to sell yourself on stage. And that's one of the things that's happened over the last 10 years. Founders have become much more pitch practiced than they used to be. So they're actually on the stage, they can attract people more easily for that initial conversation. So it becomes even more important that you spend time working out whether there's anything below the surface of this extremely good actor on stage. No, the person, if they've got that level of emotional awareness, they'll realize, because the board will have other members on it, almost certainly older people, or wise, not necessarily wiser people, but more experienced people, they'll realize that they are pushing against certain things that perhaps they shouldn't be doing. Now, it's important they do push. I mean, in the end, this is their company. They won't necessarily own half of it for the whole way through, but it's their company, and that they can decide what they want to do. The investors shouldn't decide. Sometimes happens they do. So they've got to realize that other people who are perhaps advising something should be listened to. That's obviously within the board, but it's in the bigger picture as well. And if they can realize that, they're going to try and hopefully ask for advice in this personal growth story that they need to be on, either internally within the board, but more likely somebody who's independent of the company. So the warning signs will be things like, and some entrepreneurs will, if they listen to this, will think, well, I've experienced that and I was right, is the fact that the board doesn't seem to be agreeing with their progress in what they want to do with the company. Now, that's a really delicate one, isn't it? Because why should a group who are older than them, who haven't necessarily had so much experience, be right and not? But if there starts to be board friction, something needs to change, because otherwise, particularly if there are investors on the board, the next round is going to get really difficult. If the founder CEO is starting to fall out with the investors, then that business is, really going to struggle. That doesn't, of course, mean that the entrepreneur should follow what the investors say. That's the big thing. It's because they've still got their dream, and they want to carry on with that. So it could almost be argued that a founder wants to get to a certain size, say 30 people, should have some external coaching, or at least have some external checking to check that they're in the right place to carry on growing with the company. Or, which happens, for instance, with a friend here in Cambridge who sold his business to Amazon. It's now called Alexa. So he sold it was 30 people, and it's 12,000 or something now.
Wow.
He stepped aside. He recognized he didn't have the ability to grow at that age. He's got another business now, but to actually do that. So he stepped aside. I'm not sure who tapped on his shoulder first, or he actually said, we need to get somebody in. Google, Larry and Serge, they stepped aside almost immediately, didn't they? Because they knew they were too young. They brought in, can't remember his name now, who then grew the business to a certain point, and they took over again. They realized that actually they were start-to-be type people and not scale people. So bringing somebody in, I've just been to my best exit of all, which was 107x yesterday, where after the private equity came in and bought me out, they replaced there were two founders, both called James, as it turns out. James Hyde as the CEO, replaced him with another CEO from industry who'd already been on the same journey in a much bigger company. And I met them talking to each other yesterday, just at the over in Northampton, and it was clear that James was really happy that he'd stepped aside and had another role. And this woman who'd come in, who had huge experience in the industry in a much bigger organization. So basically, James and James grew it up to 150 people, and now she's taken it on to, who knows how many people there are now. It's a massive, massive place because it's a warehouse. So it's knowing when when the limit occurs, and bearing in mind even if you've stepped aside and probably still on the board as the chief product officer, or maybe the chief technology officer is unlikely, you've still got a big chunk of that company. You know, it's still really important to you. Likely that the entrepreneur has by far the majority of their potential wealth tied up with a shareholding in that company. So let somebody in who's got the experience and knowledge to actually grow. Not easy to do because they'll need to trust that person implicitly. But if you can do that, you can get some really great results.
Yeah, what I'm hearing here is this depth of self-awareness that is absolutely required to lead a startup, a successful scale up, and ultimately a sell up. And again, what I'm hearing, what's being inferred, is essentially you are creating an organizational vision, a vision which you feel that you have the appropriate skill set for, but you're constantly checking in with yourself, with others, ideally an external coach, the board, to actually get independent advice on your capability, on your skill set, because ultimately you're creating something that is that is not, it's essentially that detachment of your identity as the founder, your identity as a CEO for a period of time with the organization itself, and understanding that essentially you're in service of this organization, even though the cap table might say that actually, you know, you're the majority shareholder. In the context of your role as CEO, you are in service of the organization, and at points along that journey, it's really important for you to constantly check in with a board if you have that board, with a coach if you have a coach, but receiving that external advice. So that's such sage advice. Any other skills, Peter, that you have identified that are so critically important in the scale up phase that may not necessarily be as important in the startup phase, and maybe vice versa, where there are certain skills in the startup phase that actually may trip you up in the scale up phase?
Yeah, one thing that is always well worth doing at the early stage is for the founders, or at least one of the founders, to understand finance well. So this means that they understand what the numbers are. They can read a balance sheet. A young entrepreneur is very unlikely to be able to do that because they haven't bothered to do it. They didn't think it was worthwhile. But it'll make a big difference when later on, when you've got external investors in, you're having conversations at board level. And it'll make a very big difference when you can start to analyze the KPIs necessary to actually scale a business properly. Customer acquisition cost, lifetime value. So understanding finances. And although it seems like a bit of a waste of time, I've often seen one of the founders, usually the technical founder, actually, although it should really be the CEO, the commercial founder, actually doing the books themselves just to start with for the first few months. So they get to understand what the what the structure is, what all the terms mean. You know, even things like debtor and creditor, you know, receivable and payable, as the Americans call them, are really important. So having a grounding in a critically important part of the business, it's very unsexy really, because all it is numbers, but they can understand that. Now, of course, they don't need that when they don't need any of the finer detail of that when the company's scaling, because they'll have staff to do that. But you need to understand what's coming out of that. I mean, I've got a great example on our website of it's not expressed in detail, where I completely messed up with my own company because the bookkeeper, who we hadn't obviously trained well enough, was taking cost of goods, it was a manufacturing company, and putting them onto the balance sheet as stock rather than against shipped goods. So the balance sheet was increasing, and I couldn't understand where we were profitable because, you know, it wasn't being used to sell something. I couldn't understand why our borrowing was going up.
Your margins were great and your balance sheet looked
exactly, but we needed more and more cash to run the business. And suddenly, I remember really clearly where I was when I suddenly thought, oh my God, you know, and because I didn't really know enough about accounts to have challenged that. So that's a really important part.
Yeah.
Something that's, again, needed later, sorry, just to go on to the other side, is motivation of sales teams. So getting that, you know, understanding the psyche of an external salesperson. Of course, the founders will be the sales team to start with because they're the best sellers of all. They understand the product, the service, they hopefully understand the customer, they understand what can be delivered and what can't be delivered, etc. But at some point, you're going to have to outsource, or not outsource, insource to somebody else. And getting those salespeople in, I mean, they're the ones you tend to have to fire earlier because they can sell themselves, but they can't sell the product or service. But getting to the point where you can work out how to motivate these, because salespeople are very different from tech people. Want to do interesting tech stuff. Administrative people want a good working environment, but salespeople want a Porsche basically in many cases. So they're motivated by the package, and so getting that in place that doesn't become gameable or too complicated is really difficult. And generally, if you can afford it, you get somebody who's done it before. But if you have to learn that yourself, you don't need that at the beginning of your talk because you don't really have salespeople. But in order to scale something well, you're going to have a really good sales team, particularly if you're going to really grow rapidly.
Yeah, and implied within that is your ability, and it goes back to psyche again, your ability to delegate, because in those early stages you will be doing lots of the things, including selling, creating the product or service, likely the accounts in the evening, issuing invoices, all of that good stuff. In the scale up phase, you're going to arrive at a stage where your psyche, your ego is not such that you feel you need to be involved in every deal, that actually you're willing to create a sales playbook. So, document what's making you great. Why are people buying off you? And having the ability to inspire and motivate others, undergirded by great processes and systems within the sales function. I was speaking with Jack Daly, an incredible individual, a guru on all things sales. And the first question he asks people or leaders of organizations when they invite him in to motivate his sales teams is, send me the sales playbook. Because if you don't have a sales playbook, then I can't support you in actually developing what it is that you're trying to do. And so really, really great advice, aligns with many of the speakers that we've had on, and speaks loudly to our 10 principle ScaleX framework. We've spoken about psyche, we've spoken about the importance of people. We don't build businesses, we build people, and people build the businesses. We've spoken about performance and the understanding, having a good understanding of the numbers and measuring certainly what matters. We've spoken about the importance of having creating a positive growth culture. Just moving on to kind of post-investment, and kind of once you've toasted the champagne, you've had the euphoria of securing this investment, how do the leaders of the organization go about cultivating healthy stakeholder relationships?
Yeah, right. Stakeholder, you mean investor relationship?
Absolutely. Yeah.
That's really important. Hopefully, the relationship will have been built up during the sales process when they're selling equity. So you've got some bond, some chemistry that's working well. I mean, can be slightly different for later stage companies where the Series B perhaps or something like that. It'll be done a lot with numerical due diligence rather than character due diligence, really. So you're going to have a board of some sort. Certainly in the UK, this doesn't apply throughout the whole world. It's completely normal or accepted or necessary for a board member, the investors, to have a representative, the investor director on the board, which is it's a legal term in the UK. A director has got legal responsibilities. That's not true in other countries necessarily. And but then suddenly you've got a board meeting which involves external people. So the company, if it's very new and it was just a pitch deck, they probably haven't had board meetings, but most companies will have had some board meetings, you'd hope, because those results of those board meetings, the minutes will probably be part of the due diligence when an investor comes in. But it becomes much more formal, that arrangement. So first of all, the board meetings need a pack beforehand and not, half an hour beforehand, a day beforehand. So this is structuring information flow, which is quite time consuming for an early stage company, but really important if they're going to grow, because that is a real key part of the interaction with the board on a, say, a monthly or a bi-monthly basis. So making sure that relationship with investors is good, with the investor director is good, is critically important for them, because they're the persons representing the other investors who will absolutely guaranteed, well, not 100%, because I had one company, I had no companies that have exited after only one round, but I've certainly had ones that have gone bust after only one round. The investors are needed for the next round, and it's generally the case that 18 months between rounds, 18 months is about the time for the value to be increased. During that time, spend will almost certainly be less than expected because hiring's so difficult, but sales will be much less than expected. So actually achieving the business plan after, say, 18 months, it generally doesn't happen. So the money comes in to support the revised version of the business plan, assuming there's enough faith there. So keeping the relationship with the investor director really important, but also keeping the shareholders who's sitting behind, which is, the chances are there are something between 4 minimum, 5 minimum, probably 15 maximum, and early after the first round, is getting information flow back to them. And I, if I'm deal leading, will insist there's something in the legals that says they must provide an update every 3 months. Not every month, that's far too often. Not every year, that's far too infrequently. So every 3 months is something that might just be a page long or 2 pages long that goes back to the shareholder. So they've got something they can read and feel that something's going on. So it's information flow. It's good quality information flow. You wouldn't release absolutely everything to the shareholders. So if you lost a customer, you probably wouldn't say that, but you certainly would if it's a big customer at the board. So being slightly less information flow outside behind the shareholder. So that's the stakeholder, is keeping them in the picture, basically, being truthful, honest, transparent. But at the same time, because you'll probably need money from more new investors at some point in the future, you've got to start building those relationships up as well. So these aren't stakeholders, these are future potential stakeholders. And one could spend an awful lot of time doing that if you're not careful. But you've got to do some of that, because at some point, if you're starting with angel investing and you've got a journey that's really going to go well, you need venture capital. Venture capital, of course, is still capital, but it's a completely different feel to that capital. I'll stop there because there's so much more I could say. If you carry on, Brendan.
No, I'm fascinated with this, conscious of time, but I want to come back to something that you shared right at the outset. So there are 5.7 million SMEs in the UK. There are 400 million SMEs globally, and they are critically important for the lifeblood of our communities, for society and economies at large, which is what drives our passion and our purpose in everything that we do. The stat that shocked me, and I haven't heard this before, is that only 200,000 of those 5.7 million SMEs have actually sought external finance, have actually sought by way of equity finance. And I'd just like to kind of poke at that a little bit more. What's going on there, Peter? Because I suspect, I don't have the stats for the US, but I suspect, given the nature of the US economy, and certainly the investment community there, anecdotally, much more appetite in relation to risk, and much more entrepreneurial in terms of just the cultural DNA in the US for US listeners. But what's going on in the UK? Why is that figure so low?
In fact, you use the word sought, and the sought is much higher than that. This is accepted and have external shareholders on the cap table. Now, that's a number I used, but I haven't got any. I couldn't put a link in the show notes to tell you where it came from, but I explained where it comes from, or what the numbers I remember. remember, because COVID made a big difference to this, and of course now with investments, capital availability is much, much less, and M&A is much less than it was pre-COVID. So the numbers we used to talk about in the UK were about 60,000 companies thought they could get equity investment. So they were pitching stuff around, whether it was crowdfunding or angel groups or individual angels. And of those, about 6,000 managed to raise funding. So 1 in 10, which is about right. That feels right. I mean, the number of in my heyday, because my brand got so strong here in the UK, I was receiving about 2,000, no, less than that, 1,500 business plans a year were coming into my inbox some way or other. And that's despite my investment criteria being publicly available on the website. And I invest in about 6 or 7 a year, so that's about 1 in every 200. The number I just given you is 1 in every 10, and this is 1 in every 200. And VCs talk about investing in about 1 in every 100 business plans that comes through the door. So you've got this 6,000 that have investment. I suspect that's many less now. I suspect that's probably about 2,000. So if you then take the average life of a startup before exit, if it's had external capital of being, say, 10 years, you've only got 30,000 on the go at any one time. 3,000 times 10. So, those are the early stage companies. Then you've got to, of course, add in the few thousand that are quoted companies. And you don't, even 200,000 might be being ambitious here. I'm talking about ones where we've got external, non-familial connected investors. Obviously, if it's a family business of some sort, or it's been around for 100 years, that's different because that would build it up. I'm talking about the newer ones. That's why I've come up with that number. Relatively small, and everything else is just owned by you, me, independently. The businesses I've run, most of my businesses haven't had external investments, the ones I've founded. So.
And again, I suppose I'm putting you on the spot here, but do you feel that there are so many more businesses that could scale if they could get over the mindset belief that actually it's important for them to own 100% of this?
I was involved with, I can tell you, the Federation for Small Businesses, which is a trade body here in the UK.
Yeah, I'm familiar with it.
Businesses. And the reason I got involved was because they wanted to try and educate their members that external equity was a good idea, just what you just said. And the statement I remember, I couldn't possibly tell you who it came from, was, I'd rather sell my own grandmother than sell shares. People who knows, that's obviously fictional, but that was some of the attitude. It was, the last thing I want is somebody like me on the cap table pushing me around. So there's definitely a feeling, possibly less so with crowdfunding, crowd equity funding, because that's definitely got its place, although it may well be dying away in the UK. But there's a feeling that having somebody else on the cap table, that they're going to influence, bully, control, or whatever the journey.
Yeah, I mean, that resonates strongly, especially in Northern Ireland, and where it's dominated, the SME landscape is dominated by family-owned businesses, and certainly there would be a paradigm within business that it's important to keep everything in-house. And for us, really, it's back to the purpose of taking these wonderful products or services that these organizations have developed, creating an organizational vision and developing leaders who serve that organizational vision such that they can bring these wonderful products or services to the world. And my belief is that there's a psychological barrier and a mindset shift that has to happen in order to, I suppose, change the perception of the external equity and external shareholders.
Which has probably happened in the States already, hasn't it, by the sound of it? And it's probably even further away in Germany, where the Mittelstand and the family-owned businesses are a core part of their economy.
Yeah, that's right. Peter, is there, just before we move into the close, is there any resources that you encourage people to look at, that you can signpost people to? We'll of course put links to your wonderful website, and you're incredibly transparent on that. You document clearly your 76 investments, the successful ones, the failures, the multiples that you've achieved, all of the incredibly transparent with the information that you share. So we'll put a link to that. I know your experience is predominantly the UK. Can you signpost people if they're curious about this, if they're curious about starting to explore what external finance might look like by way of equity? Where would you guide them to?
Yeah, I mean, obviously, I have a lot of experience in the UK, but obviously, I've had quite a lot of exposure in Europe. So within Europe, the first place of call is the European Business Angel Network. That's EBAN. That's both for entrepreneurs and angel investors. And there's lots of resources on there. In the States, the one is called the ACA, Angel Capital Association. That's the trade body in the States. Again, lots of information on there. And then there are many other programs in all countries for doing this. It's become quite fashionable, not surprisingly, unfortunately, to count unicorns in various countries. Something that I'm very anti the word unicorn, I must say. We haven't got into that, but obviously you'll point out that my books, but there are other books around that, in a similar vein. The Angel Co-Fund here in the UK, though not including Northern Ireland, I think, provides capital to early stage companies. Again, there's quite a lot on their website. There's a lot of information out there just by picking up a search engine, actually. So I wouldn't say there's clearly no definitive way of doing this, but there is a lot of information there. But it's the human touch you'll need at some point. An entrepreneur, if they can find somebody in their local community who's entrepreneurial, has been entrepreneurial or is entrepreneurial, and just having a coffee or a beer or something with them, that will make, you'll learn a lot from that.
Yeah, and to support those SMEs who have ambition to scale, who have come into our own program and they understand, or they've been challenged with access to finance as an impediment to their scaling ambition. We've actually, I'll just give a plug for our own investment fund, ScaleX Investments. But one of the conditions of that is that we only support or only consider graduates of our program, or those who are currently going through the program or are about to be onboarded onto the program. So before we receive lots of inquiries from startups, that's not the part of our own investment thesis. But the point is that we get an opportunity to get to know these people intimately over the course of 12 months. Back to your point right at the outset, it's about investing in people.
Yeah.
Peter, I want to change track. You are an incredibly inspiring individual, and what we haven't touched on in the last hour is the personal challenge that you are battling with, if we use that word, but battling with on a daily basis. You're living life to the full. But can you share with our listeners why that might sound strange, that we have a 68-year-old man who has this incredible experience, who's sharing his time, his energy, his wisdom today, and you're living life to your full? Why that might sound a little bit odd for many.
It does, doesn't it? Yeah, and as you'll show in the show notes, I'm actually writing a book at the moment called Public Success, Private Grief. So yeah, I'm successful. That's fairly clear from what we just discussed. But an awful lot of stuff's gone on in my life, as it does in all people's lives. But I just seem to have had a bit more than many deserve, or not deserve. On a day-to-day basis, I'm living with advanced cancer. So it's cancer that, when it was discovered 2 years ago, had spread all over my body, in my hips, my spine, my lung, my lymph systems, in my brain, etc., etc. Luckily, I'm on a targeted therapy, which is a daily tablet, which just means, and I'm lucky not to have many side effects. So I've just gone on with life, because actually, if you look at this, the data, and there's hundreds of thousands of us with this particular mutation of cancer, I've probably only got about 13 months to go. Statistically, clearly, I'm doing my absolute best to go past that with taking, exercise, diet, positive attitude to life, doing lots of research, etc. And I've got a YouTube channel called Project Cancer, which describes what I've learned about living with cancer. But on top of that, I have some other tragedies in my life. The loss of both my siblings, younger siblings, when one was 21 and one was 53. The loss of two of my children, one at 23 and one at 34. It may well be connected in the books exploring this. I'm a recovering alcoholic. I haven't had a drink for 23 years. So there's a lot of shit, to put it bluntly, that's occurred in my life. And from that, and the reason I'm writing the book is hopefully going to be inspirational for others, that despite that, I've somehow managed to personally develop and grow from that, to continue to help people even more. I'm even more driven to help others. We haven't been mentioned, I was on the board of 7 charities in the UK over a period of 15 years, in 3 different sectors. I've written the books. I'm spending a lot of time just talking, helping people, whether it's mentoring, or I've done nearly 100 podcasts myself, or whatever. So yeah, there's something that's driving me to ensure that my life has been worthwhile to others, despite the shit that's happened in it.
Wow. Well, you're looking brilliant. You sound brilliant, and I'm really, I feel really privileged that you've taken the time to share it with me and our listeners today. I ask this question to all of our guests, but we're more than 100 episodes in now. I've never had a guest who has had the depth of personal and professional experience that you have. So this is quite profound when I ask this question, because I suspect that your view on this will have changed significantly, in recent years, and certainly in the last decade. Can you share with our listeners 3 timeless takeaways?
Interesting question. And so I certainly can do quite easily in terms of business. And I'm just at the process of, so I've written a letter to my 29-year-old self as a CEO, which is on my website, and learned a lot from that. And I'm just at the moment drafting a similar one, probably to my 19-year-old self, for my personal life. But I haven't finalized that yet. So I'm going to have to try and make this up as I go along. I mean, I've got the business ones, which are, we could talk about if you want, but they're on my website anyway. But the Americans have this term, don't sweat the small stuff. We all do sweat the small stuff. There's something about life where if you could avoid that and just get on with living life and not worrying about the small stuff. I know it's really difficult, and I've sweated the small stuff many times, but looking at it as a whole, we're only on, as we know, depending on one's religious beliefs, alive for a few decades, which is not long. And there's a lot of preparation, education, everything. So the first 20 years, you don't really experience life. You just through educational process. So there are much bigger things to worry about. So that's the first point. It's not my phrase, but don't sweat the small stuff. Secondly, which again is said by many people, don't delay, don't put it off till tomorrow. Do make decisions. Don't procrastinate. Just get on with life. There are obviously things get in the way. There are commitments get in the way. There's financial resources get in the way. There's time resources get in the way. But just like you've just been cycling, haven't you, in Southeast Asia? I mean, that's the sort of thing. Yeah. I know because you've got the money to do that, you've got the time to do that, and everything else. We all have different pulls on our lives, but just get on and enjoy life. And thirdly, which is again, I'm just making this up as I talk to you. Somehow use external resources, whether they're professional or written, to work through grief in a way that's going to lead to growth. Now, I went to a conference in Slovenia about 4 or 5 weeks ago on suicide prevention. And one of the things I learned from that was post-traumatic growth. Somehow work out that post a trauma, and most of us go through a level of trauma, whether it's even a grandparent dying. If you're close to a grandparent, you know that is a level of trauma, plus all the various other things that happen, car crashes and so on. But if you can somehow work out how to grow from that, to personally develop from that, it makes a massive difference. And somehow I've managed to do that. I haven't worked out how yet, but somehow I've managed to do that. So those are the 3 off-the-cuff takeaways, literally made up as we're talking.
Selfishly, and I don't normally follow this up with another question, but I'm really curious in terms of the first one and not sweating the small stuff. You know, you've acknowledged we all get snagged on the small stuff. How have you changed what was potentially habitual in terms of the way you reacted to small stuff since your diagnosis? Are there any practices? Are there any kind of affirmations? Are there any daily rituals that you practice which helps you kind of move beyond this kind of this habitual thinking around the small stuff?
Well, there is, because my time is limited, so I want to use it efficiently, but not in a selfish, egocentric way, which is why I'm still doing things like talking to you over this. And we only met each other because I happened to listen to you on radio when I was hiking in County Cork 2 or 3 months ago. It's prioritization. I have a bucket list, and I have another list which sounds like bucket, but it's got an F to start with. And probably work that out. I don't know whether you
go for it, Peter. Go for it.
So it's a bucket list, and the bucket list is the one where I just decide that it's not worth doing. Now, I've got to do it in a kind way, because I get so many people coming in wanting for advice from me, etc. So I have this list of things that I just won't do. And that has made a big difference, actually, to the way I look at life. So I've managed, because I'm old enough, I've managed to sort of, and wealthy enough, I've managed to retire. So there isn't a pressure on me to earn money, but at the same time, so it means I can spoil myself somewhat. And I got engaged in the Galapagos.
Oh, congratulations.
And got married in June.
Good on
to
you.
Lise, who's helping me write the book. But it's a matter of just spending a bit of time thinking, is this part of my new life, in my new short life? And I had a wonderful time with my wonderful life coach last night, actually, Katie, who going through the plan, which was a 500-day plan, which I set up a few months ago. And now it's a 370-day plan, and working through and making sure. This seems really cold, doesn't it? Here I'm on a journey to an early death, and I'm talking about planning that time. I mean, I don't know how this is going to come across to other people who are listening to this, but this is just the way I am and how I'm coping with this.
Yeah, for me, this is wonderfully profound. In many respects, we all come into this life with a terminal diagnosis. Exactly. There's no one getting out alive, and it's not a question of if, it's just a question of when. What has been the catalyst for you is the fact that you've now researched to lean on to suggest that, well, here's the period of time that I've left where for others who aren't battling with, I can't imagine what you're going through, but aren't battling with cancer. We tend to believe that, we can put this off, we'll do that tomorrow, we'll have the family holiday next year. Oh no, maybe, in Christmas 2025, we'll do that. And the reality is none of us know if we're going to reach there. So I suppose, like you, I've decided, we booked a family trip to New York for Christmas. Typically, that would have been something that I would say, well, maybe no, we'll do that next year, or kind of rationalize why it wasn't a good time to do it. And I've come to a point, like the Vietnam Cambodia trip, the charity cycle, that if an opportunity presents itself, I'm going to do it. Because I look back at photos of the kids, my eldest is now 20, and go, oh my God, where did that last decade go? And no one knows when they do something, whether it's hug their kids, whether it's hold their hand to take them to school, when is the last time? You know,
Interesting you say that, because one of the chapters of the book is probably going to be called The Last Decade, the lost decade,
yeah.
because of my alcoholism. Because I think, and that goes into great length about all of what I lost, and then my recovery and what I've done from that. So again, life is short. Life is for living. These are all adages that I haven't made up, clearly, but just get on with it. If that's the takeaway from the listeners of this, just get on with stuff. Then we've done a good job here, haven't we, Brent?
I love it, Peter. I love it. You've inspired me. I feel energized, and I love your attitude. It's infectious, and goodness me, the man across me has lots of living to do yet. So speaking of that, look, you've mentioned the new book a number of times. What else for you then? When does the new book come out?
Yeah, so we hope to have finished writing it by Christmas. I can't find a publisher because I'm just not famous enough. I need 100,000 followers on social media. I've only got about 10,000, so it'll be launched in March. But in the meantime, provided my scans are okay, because I live on a 3 months to 3 month scan cycle, I'll be going to Antarctica in January and skiing for most of February, and then then the book launch, and then if that works out for the next 3 months, I'll be going to America for a month, just in an RV, a motor caravan. But at the same time, in this process, is spending 2, 3, 4 days one-to-one with some of my closest friends. This is sort of like saying goodbye, but at the same time, it's a weird thing to think about. And I've got about, I don't know how many there'll be, but how many people can fit it in. I think most people will fit it in if they want to, because they know this is, of course, what might happen. Of course, I'm still living in 10 years' time and doing it again. I would sincerely hope that is the case.
Well, likewise, Peter. I really do feel honored that you have taken the time to share your energy, incredible experience, wonderful wisdom with myself, my listeners today. I do feel wonderfully privileged. For people who want to find out more about you, where best to contact you?
Yeah, so petercowley.org, which will be in the show notes. That leads to investor.com, which is the book and the 80 odd podcasts. It also leads to Project Cancer, which is the YouTube channel. And it also leads to what I've called PS-PG, Public Success, Private Grief, which is just a holding page to gather interest. And we'll be doing pre-orders for the book in the next month or so.
Well, Peter, look, I wish you every success with that, and I encourage all of our listeners to visit Peter's website. It's just a vault of wonderful resources, both professionally and personally. I was captivated when I got onto it and started to research you a little bit further. Peter, I look forward to staying in touch and hearing all about your ski trip in Antarctica. That's just incredible. So thanks again, Peter. Take care.
Thank you very much, Brendan. Thank you very much indeed. Great interview. Thank you. Thank you.
Peter.